We are fast approaching, believe it or not, the end of the quarter. And a big question for investors is what kind of impact those quarterly reports will have on stocks. Bob Pisani takes a look.
The big debate is this. Are we at peak earnings? Earnings have been growing all year after growth declined in 2015 and 2016. That was a period that saw the markets move down. The question now, is that growth spurt over? The short answer, it doesn't appear to be. First, profits are still up, but at a slightly slower rate. Overall earnings for the S&P 500 are expected to grow 6.2% in the third quarter. That's a bit slower than we saw in the first half of the year. All right, why the slowdown? Some of the sectors that had big moves up are hitting tougher comparisons, principally energy and tech stocks. So, for example, energy bottomed in the second quarter of last year and had a huge boost in the second quarter of this year. Okay, but estimates for the fourth quarter and next year are still higher. In part, it's because the economy is continuing to grow. That's the most important thing. This year, analysts expect the S&P 500 stocks to earn 10% more than last year. For 2018, earnings are expected to grow an additional 7%. That's good news, but this growth does not have any tax cut assumptions in it because no one knows what they are. But today we're getting a little closer to an answer, so we can venture some guesses. The effective tax rate, what corporations really pay, is about 27% for the S&P 500. Each 1% cut in corporate tax generates roughly $2 in earnings. So let's assume that the rate goes down 4 percentage points to 23%. That would add $8 to earnings. So the 2018 estimates go to $148. That's a big boost, 6% more on top of the 7% expected without tax cuts. That's why the market keeps holding up. The combination of expected improvement in the economy and the tax cuts give indications that we are not yet at an earnings peak. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.